Again, thank you so much for joining. Tonight's presentation is actually on the 2024 market outlook and investing in the election year. We were planning to do this last week, and unfortunately, I was ill and we had to delay the webinar until today. So I thank you for that and thank you for your patience. So let's kind of get started. My name's Tom Mitchell. Many of you have already have met me in prior webinars. I have the honor and privilege of leading the OneAZ Wealth Management team of wealth advisors located here at the OneAZ Credit Union. Our full-time professional staff of advisors are assisting clients and helping members of the credit union all over the great state of Arizona. And we're always very excited to bring you these kind of presentations directly to you. We did 10 webinars last year, 10 different topics, I should say. We did 20 webinars, but we actually did 10 separate subjects. We have also scheduled somewhere around 10 new subjects for this year. So those subjects are coming from you, the audience. So please email us and share with us some of your thoughts and ideas as we construct our calendar for this year of 2024. First, this is an informational page. It contains all the required legal disclosures for your convenience. Now, for better audio, the webinar is going to be in listen-only mode. Now, we will be fielding your questions at the end of today's webinar, and we've received a number already. But if you have a question that you would like us to answer, please email us at oneazwealth@oneazcu.com. We're compiling those questions and we're going to answer as many as we can today. But if we don't get to your personal question today, I know that we will reach out to you individually and personally to answer your questions. Last, for more information about OneAZ Wealth Management and our team of advisors, I urge you to visit our website, again, oneazwealth.com, or you can use your mobile device and just scan the QR code that's right on the screen right now, and you'll go right to our website. And lastly, we'd like to stay connected with you. So please join us and link us up on Facebook, LinkedIn, and also the YouTube. We have materials and presentations and resources we share on those social media sites that I know that you might get benefit from. So please make sure you connect with us, OneAZ Wealth. All right, to help me with this presentation on the 2024 market outlook and investing in an election year, I've asked one of our advisors, Zach Hawley, to join me and to share his thoughts and insights. Now, a little background of Zach. He's been with us for he's actually been in the industry for 10 years. Zach has worked as a financial advisor and focuses on really retirement planning for credit union members at all stages of life. Zach began his financial career with Mass Mutual and also since worked at Edward Jones and Financial Engines before joining OneAZ Wealth Management in 2019. He completed his extensive trainings to earn the Chartered Retirement Planning Counselor, the CRPC designation, as well as the CFP, the Certified Financial Planner designation. Zach also holds his bachelor's degree in psychology from the Arizona State University. So, Zach, are you there?
Tom, I am here. I appreciate the introduction and appreciate the opportunity to be here.
Great, great. Well, we welcome you, Zach. I know you'll be sharing a lot of good insights as you did earlier today during our noontime webinar. As we compile our presentation this year, we pulled data and slides from two strong, reliable sources. The first was the Capital Group. Now, they're well known, and maybe you know them from as the American Funds Group. And we also then pulled slides from our own broker-dealers, LPL, their own research department, and they've brought some insights that we'll be sharing as well. Now, just to understand, the Capital Group slides is what I'll start with. They generally are a little more optimistic. LPL research is a bit more conservative. So let's dive in. You know, we talk about getting back to the old normal, and let me explain what that really looks like. If you look at the chart going back 150 years, the long-term government bonds average between 3 and 6% for about 61% of the time. And while we know the Federal Reserve's mission is to tame inflation without widespread economic pain, or to even have a recession, the 10-year Treasury yield actually underpins the borrowing costs that much of our economy is driven by. Now, these borrowing costs have actually risen, and if the Treasury yields have also rose with those Fed fund increases, they're in the 4 range, in the low 4s right now. That's the Treasuries, but the Fed funds rates are over 5 now. So the big question we hear all the time is, will these higher rates stick around, or will growth start to deteriorate, and then forcing the Fed to slash borrowing costs? Now, we all may have heard last week, Fed Chair Jerome Powell recently announced at that January 31st meeting, he has no interest in moving rates right now. Now, that happens to be the 4th straight meeting where he has announced no change to interest rates. 4 meetings. Now, the next meeting is scheduled for March the 20th. And then the one after that is May 1st. So know that we have a couple more coming up here before summer. But the call out here is really the rates have not risen for the last 4 sessions, but they haven't gone down either. So they remained unchanged. Now, the Capital Group is somewhat optimistic that consumers are actually going to continue to carry the economy, even as rates kind of remain a little higher right now for this extended period. That's partly because wages and home values remain above the pre-pandemic levels, which has helped support consumer spending. Now, the federal spending, which we know the federal spending has actually buffered the economy, which has driven up our federal deficit, which we all know through the COVID monies that were spent and invested. That all came in and really helped close out it's getting closer to about 8% of our GNP. But let me kind of share a couple things on this slide right here. I wanted to call out this whole, if you go back again to 1870, this 150-year period, if we look at interest rate cycles, look how long and how often they have been in that 3 to 6% range, 61% of the time. You got to go back way, way back here in the 80s. Actually, I started in the business here in 1981. And since 1981, I've seen a 40-year decline of these rates as they continue to come down over that 40-year period. They got down in the low 2s, but then eventually they've started to come back up, and they've come up sharply and quickly. Mm-hmm. So the question is, will they continue, right? Now, with a lot of speculation on that, we'll talk a little bit more about it and some of the forecasting some of the different firms have. But I just wanted you to get an idea that 3 to 6%, which we're in now, is not abnormal. We're actually getting into the normal range if you want to look at it historically.
It is pretty incredible, Tom, when you get used to something and then things change. No matter what it is in your life, it can be something that takes a little while to get used to. But you're right. This is going back to normal rates. It's a rate that the economy can still grow on, is what they believe. So we'll see what happens.
Well, and the thing we're going to talk about is housing and a few other things too, how that's been addressed with the higher interest rates, where new home buyers are finding it more difficult to buy a home. The mortgage rates a few years ago were as low as 2.5 to 2 3/4 for a 30-year mortgage. Now they're well over 6% for a 30-year mortgage. That's a huge increase. And that makes it a very difficult time for some home buyers at the startup. However, over the last 2 years, we've had pay raises too. People have been receiving pay raises and higher incomes. So that's helping soften that huge jump. But we know when interest rates start to be cut, or when the Fed chair decides that the rates need to be brought back down a little lower, then I know that's going to fuel up the economy quickly.
Mhm.
All right, one of the things is we talk about this recession. Everybody's been forecasting this recession. It's probably one of the most predicted recessions of all time. It was going to happen in 2023. Well, did it happen? Well, the answer is no. But Capital Group says the answer is actually yes. They call it a rolling recessions, plural, because this rolling recession, one recession just didn't happen where everything went down all at once. They rolled. There were several different sectors and industries that had different times. Over the last year and a half, these different sectors experienced these downturns at various times. This phenomenon is called by the economists rolling recessions. Now, this is a rare event. And if by having this kind of a rare event, it's possible for the U.S. not to experience a traditional recession before the end of this year or even next year, despite the burden of the high inflation and even these higher rates. Now, for example, on the national home or national residential housing, they contracted sharply after the Fed started their aggressive rising of rates. And at one point in 2022, actually, you can see it right here, they actually had a 40% decline. But now we're seeing a comeback, right? We can see the comebacks. All these red times were actually the dips and the times when these rolling recessions from the various industries have come into time and have now rolled out. Can we roll all back into them? Sure we can, but it's not probable possibly. So the facts and the forecasts are looking very rosy here.
And recessions are part of a normal economic cycle, Tom. If this rolling recession where an industry that's not doing so well is supporting other industries as they go through their downturn in the cycle, that might be something that leads to this soft landing that people have been speaking about.
Yep. Now the Capital Group's forecasting the U.S. economy could grow at an annualized rate of roughly 2% in 2024. In fact, if you looked at the fourth quarter of 23, GDP was actually 3.3%. Very healthy. Now, let's talk about us here in Arizona. As Arizonans, some of us might not have felt this recession or any of these rolling recessions as we see, because actually we live in a very unique place. People are wanting to move here. Our labor market is stronger here. So we have a lot of pent-up demand in our world right here, and we are somewhat insulated from some of the real national issues that are actually out there. Now, the Capital Group believes that corporate earnings will continue to rebound also in 24. Now, when it comes to stock prices, one of the main metrics that matters most is actually corporate earnings, our company earning money. Now, in the U.S., Wall Street analysts are expecting earnings for companies in the S&P index to rise more than 11%, 11.4, they're forecasting in 2024. Now, they're also forecasting out there a 6.1 earnings boost in the international markets, and then also in the emerging markets, a very robust, almost 18% growth. So Capital Group is feeling very confident that corporate earnings are in a good place and in a growing place right now. So we all know in 22, and I'm going to go back a year here, more than 23, but in 22 was a very difficult year. And I know with interest rates starting to go up and bond prices collapsing and falling, I mean, everybody was shell-shocked at what to do and what was going on. And the markets really took it hard. So 22 is a very difficult and challenging year. However, investors are still on, a lot of them ran to the sidelines, and some of them are still on the sidelines with cash. So the call out here is by keeping money in cash for these unique periods where there's those downturns, you could lose out on historical windows of opportunity to reposition portfolios for the longer term success. Historically, after the Fed hikes end, and basically we basically have had what? 4 Fed meetings where there's been no change to rates. Usually what happens is stocks and bonds have historically done very well. Now, if you look at the charts here, for example, bonds, the year following when the Fed stops hikes, they're looking at a 10%. Even stocks, they're looking at 16. And actually, that's about where we are right now. And then if you look at the 60-40 blend, that's just blending stocks and bonds, you're looking there at 14% on a blended basis. But I like to call out the next number. The next number is the 5-year number. That's if you stay in for 5 years following that Fed hike. If you have bonds, you're going to be up on average 17 or 7. If you're looking at stocks, you're again coming right back to that almost normal average of 9, and then that blended average of about 8. Now, this data is based upon the last 4, I think it was. Yes, the 4 recent cycles when interest rates had gone down and actually were higher and needed to start to come back down. Mm-hmm. And that goes back to actually the mid-90s. So this is an interesting view that Capital Group is positioning here. They think that we're in a good place. So time will tell, though.
I love their optimism, Tom.
Yeah. Now, another popular topic that is that's getting a lot of attention, and we get a lot of calls and clients are asking about this thing called AI, artificial intelligence. Well, what is it? Well, you know, artificial intelligence has been around a long time. It's just gotten more attention of late because there's been faster advancements in this area. What artificial intelligence does is it helps computer learning. It helps things get solved faster. And using these technologies to drive efficiencies for companies is really where the excitement is. Now, these major advancements in this AI area, it actually captured a lot of the market's attention in 2023. It drove up stock prices for a handful of these big tech companies. But the beneficiaries of AI's ascend is actually not just in the tech world. It's actually going to affect us all eventually. You know, AI-driven applications are popping up all over the place in different industries, from pharmaceuticals to banking, even fast food. For example, McDonald's is using AI. Yeah, believe it or not, they're using AI to help make their drive-through order system faster. Pfizer is employing AI to accelerate the development of new drugs. And even JP Morgan is unleashing these AI bots to help identify identity theft when it's happening and be able to stop it and protect their customers. So this is a thing that's out there. The challenge for investors is going to be to separate the hype, excuse me, the hype from the realities, and to see really any potential exponential growth of AI systems over the next decades. I know it's a big deal. I know, Zach, you shared a story earlier of some AI experiences that you know of.
It's pretty incredible, Tom. And I look forward to the advances in AI and how it's going to make us more productive in our everyday lives and help us live longer. The article that I read this morning was a dentist that was adding artificial intelligence into his screenings and the x-rays that he would take of your teeth. It helps with diagnosis. It helps with solving the problems without the dentist making a guess. So anything that will get me away from the dentist as fast as possible without having to go back is something that is a win-win, I think, for everybody.
All right, I'll keep you up. I'll keep you on that one for sure. Let's hope that all these dentists are listening in carefully to that. Okay. Capital Group also calls out, they believe there's this forecasting of a tidal wave, a big wave of cash that's actually headed directly at American industry. Now, this and the cash is primarily coming from the U.S. government. This is no secret. This is nothing new. We all know it's actually coming. It's been committed. The US government is actually committed 1.4 trillion. That's with a T. That's the trillion over here. The big number over the next 7 years for capital improvements. Now, this investment translates into revenue and earnings growth potential for companies with the capacity and flexibility to kind of undertake these expansive projects, including upgrading the US power grid, for example, or even building new manufacturing facilities. The stimulus will also likely have a multiplier effect. It'll ripple through the economy as new facilities will create new jobs. While much of the money is yet to be spent, the trend towards energy efficiency, we know localizing supply chains, bringing more of it here, and the infrastructure improvement is already generating opportunities. For example, I read earlier that the air conditioning maker, Carrier Global, actually saw a huge demand for its energy efficient systems. They just surged in 2023 because many countries are experiencing periods of record high temperatures, and it's driving more and more desire for efficient systems. Along with capital equipment, there are companies like Caterpillar. Caterpillar, the big earth moving and industrial machinery that they make and manufacture, they reported very robust orders in 23 for its construction equipment, partly driven by, again, this federal infrastructure spending plan. This interesting chart, I wanted to call this out, is right now we're at one of the lowest times ever of using capital spending compared to the GDP, the domestic or the gross domestic product. So with this influx of capital, this could really lift a lot of companies, particularly the more, I'll call them the blue chip companies that are looking and growing and actually have a lot of infrastructure needs to bring to the economy. All right, let's take a look. This is an area that I think is very interesting. Capital Group has brought this out and is calling it out. Last year with investors, just getting all swept up, right, in this whole AI intelligence craze. Mm-hmm. And there was basically, let me say this. It's about, they call them the Magnificent Seven. They're big companies, big tech companies that drew a lot of attention on the AI area. And that's what's driven up a lot of the stock prices of the indices. The S&P, I just noticed today, almost hit 5,000. Well, there have been the good old-fashioned dividend-paying stocks, strong companies. They have actually quietly drifted towards multi-decade lows compared to the broader market. I mean, those good old cash cows are really at some lower numbers and valuations. Now, with the economic growth slowing and the shifting a little bit here in 24, the potential for recession does linger, but dividends, can take a very prominent role in driving total returns for the investor. Select dividend payers across a variety of industries are adopting strategies to drive demand for their own offerings. For example, the Capital Group brings up the pharmacy retailer, CVS Health. They're launching a new division that's going to work with drug makers to produce biosimilar versions of their leading therapies that will actually make them even more affordable. Now, having said all that, I'm just calling out a warning too. Beware, investors, about risking any concentrations of anyone's portfolios in a handful of these tech giants, for example, or even putting everything in one sector at any given time. The Capital Group,
just so we know the companies that we're speaking of with the Magnificent Seven, the companies that really propelled the US stock market last year. For those at home, we're talking about Apple, Amazon, Google, Meta, Microsoft, Nvidia, and Tesla.
Yep. Yep. Good. Thank you for calling them out. Yeah, these big sevens, and they actually have driven up a lot of these indices that we look at, the Dow Jones, but also the S&P. There have been huge gains in their 7 stock prices that have actually risen up the indices. And there's a lot of other stocks of the Fortune or the S&P 500, 490, 3 of them, right? That are kind of lagging behind. So it's a good time to take a good hard look and making sure there's some good selections and evaluations that are done out there. But one thing Capital Group is calling out, though, is these dividend paying blue chips that are out there. This may be a good time to take a look at those. They offer diversification as well as some income while you're waiting for growth. Okay, let's talk about some of the things outside the United States. And we get this call, or they get this question a lot about China, right? Everything's about China, and would they grab more in the whole spotlight and so forth. I just read something today, matter of fact, I'll just read it here. For all of 23, the imports from China were down 20.3% versus 2022. China used to be the top exporter to the US. Now the top spot is held by Mexico, where Mexico is actually up by 4.6% in 2023 versus 2022. So that's a big change. That's a big change to see China slip into second spot now. And so Mexico is our number one importer here, not China.
That is pretty incredible, Tom. And we've been speaking in the financial world. We've known India was also going to be a giant in the technology world at some point. And you can see from the chart over the past years them growing, and the technology industry in India is now valued at over 245 million and growing at an 8% rate. So the infrastructure there, the changes that India is making to be a global trading partner are things that can pay off in the future.
Yeah, that's what we're talking about right here, and in Mexico. You know, and I'll just highlight what Capital Group's saying here is they're believing this setup looks very attractive for opportunities in those various countries like India, Indonesia, Mexico, and they're calling out that infrastructure growth. You know, it's accelerating there. Also, those government balance sheets, believe it or not, are getting stronger, and the supply chain shifts are actually boosting some of these regional economies. India, I'll just call them out specifically like you did. India, golly, they have if you look at the landscape there, new roads, housing developments, these industrial parks, they're popping up all over. They've left really parts of the country unrecognizable from just a few years ago. And Indonesia is attracting a lot of foreign investment for the electric vehicle manufacturing and supply chain as well. And Mexico is becoming a reassuring hub too. So it's very interesting where we're seeing some of these countries outside the United States go. But that's enough about this, about Capital Group. Let's kind of turn to LPL. Now, as I said earlier, LPL Financial is our broker-dealer. They've got a great research department. While they are a little bit more conservative in their forecasts, and you'll see that very quickly here as I get into some of their slides. Now, LPL Research is still in the camp that a recession actually could emerge in 2024. They're calling out consumers with increasing debt burdens, depleting their excess savings, and they're just no longer able to keep up with some of the debt payments. Now, leading indicators that they're watching include the serious delinquencies in certain credit cards, as well as delinquencies in auto loans. Now, we expect the spending splurge to kind of taper off and to end, while the customers are going to now revert back to the trend. But in 2024, consumers will no longer be willing to spend as they did in 2023. And that's according to LPL's research.
You can see it with credit card debt, Tom.
Yeah.
We're seeing once again where credit card debt is at an all-time high. The average credit card balance right now is just under $7,000.
Yep. It's true. And we have to watch that carefully.
And you're paying higher interest on them than you were a few years ago. So that debt is just even more important.
Yes, it is. Debt management is very critical and important. Now, LPL Research forecasts economic growth. Actually, they're feeling it's going to occur in the later half of 2024. Well, actually, though, it's occurring now, which is kind of interesting. As I said, the S&P almost got to 5,000 at the close of today. And I'm just looking at the futures, and they're already showing it to be above 5,000 for tomorrow. So it'll be very interesting to see how it plays out. But here's a couple call outs what LPL is forecasting for 24. They're forecasting GDP to be at a very, very conservative number of only 1%. And they also think that inflation will come back down to about 2.8%. Now, on a global basis, overall, they're thinking GDP will be at 2.6 or 4.4 on a global basis. But then if we pick out certain unique areas like emerging markets, they're at 3.9 for growth, but also their inflation is going to be much higher than ours. They're looking still inflated rates, inflation to hit about 6%. So again, these numbers are just forecasts. We see forecasts and numbers estimated and guesstimated all over the place with different firms, but these are what LPL Research is indicating. One of the things that I do like on this one is where they talk about the bull markets. Now, we know we had a bull market begin here in 23. Now, with the positive 23 behind us, the next 12 months of the bull gets underway. Markets actually historically tell us solid gains may lie ahead. Of the 12 such bull market periods going back to 1950, and that's what this chart is showing. This goes back to 1949, but 1950, they're talking about the S&P has gained an average of 12.6%. And it's actually been positive every year, every time this has happened following the bull market start. And that's where these orange bars are. So I think we're in a good place, and it's thinking that we may be, if we continue through this rolling recession, as Capital Group had said, we may actually see a very good year ahead here in 2024. So we'll see. And particularly the Fed has still a lot of bullets in their arsenal to lower rates, and that could actually add more fuel to the economy as well. Another call out LPL Research is saying is the earnings per share for the S&P 500. They've upped that to $235 per share. That's up from the prior estimate of about $230. Now, the new estimate represents an 8% earnings growth from the prior 23 census. Now, if you heard that number, 8%, remember I said a Capital Group is believing it to be closer to 11%. So you can see the conservative view there. Now, this slide is actually dated. It's 2.5 months old, but wow, how things have changed that fast. If you take a look right here, I'll just jump right here. The S&P year-end target, they believed could be about 48.75, maybe even get as high as 49.50. Well, as I said today, the S&P just almost crossed 5,000. So we're well above the year-end target that LPL has issued out earlier. Now, recognize though, and I brought this up before, the S&P's valuation is actually being pinned up, in our opinion, pinned up by these magnificent 7 stocks, and Zach mentioned them there earlier. And those truly have helped provide this lift of the S&P valuation as quickly and as rapidly in this year. Now, they may pull back a little bit, but again, we have 400, 500 other stocks, close to 400 other stocks that have been in the shadows. And there might be some wonderful gems and opportunities lying underneath there. So we need to take a good look there. Okay. And then I'll just conclude here with the yields. LPL's thinking treasury yields are likely to stay higher for the longer as well. Now, as such, we think the 10-year treasury yield could stay in that 3.75 to 4.25 range. Right now we're at about 4.1. So we're right there. We're in that range. They think it could come back down a little bit. And they actually think there could be 1 to 2 rate cuts for the end of by the end of this year. Now, we know there's a lot of other forecasters out there that are believing 5 or 4 rate cuts. Who knows what they're going to be, right? We don't know how many rate cuts and how quickly the Fed will need to reduce rates. But we have to start seeing some softening in the economy. I mean, jobs are still good. The pays are good. They just need to soften a little bit. We need to see some of this these cutbacks so that they can feel that they need to provide a little more stimulus to the economy to bring down these rates. But right now, hey, as I said earlier, the rates that we're in right now we're in the average of the last 150 years, that 3 to 6% range. We're there. And so I would expect that the Fed is going to be careful and a little more slow to making any of these decisions.
And Fed Chairman Powell, I think, did a good job on not letting us get the cart in front of the horse, or the stock market, the race that it's had at the beginning of the year, anticipating these rate cuts, anticipating 3 rate cuts.
Oh, yeah.
We really need to say what that inflation data tells us.
Oh, so true, Zach. I will tell you, that's what's driven a lot of the valuations of these big sevens, is that they all thought we're going to have a lot of rate cuts. Some of them forecasted 5, 6 rate cuts this coming year. And here we are, none yet. And we're just getting this year started, I know, but there's still no weakness to show that a rate cut's coming very soon.
And the Fed has done this before, where they've tried to cut rates too quickly. Then we deal with disinflation, stagflation, many other things that the economy doesn't want to deal with. So he's doing just fine, making sure that the numbers dictate what we do with rates.
Absolutely. Now, we've talked a lot about the economics of last year and where we see maybe 24 going. But actually, you know, Zach, there's this thing called an election. I don't know if you heard about it lately.
A little bit.
A little bit. But there's this national election that's going to occur, I think, this year. And that's bringing up a lot of uncertainty. And I know you pulled together some great insights and some slides to share. So I'll turn it over to you.
Thank you, Tom. I appreciate it. And I can't believe we're sitting here and we're only 9 months away from knowing who our next president is. But luckily for investors, the presidential choice, whether Republican or Democrat, has had little to no impact on our investment returns. And as we take a look at this first slide, Tom, you'll see since 1936, we're dealing with 8 Republican presidents, or pardon me, 8 Democrat and 9 Republican presidents over that time period, looking at an annual average 10-year return. The Democrats return 11.2%, the Republicans 10.5%. I think we both agree, Tom, that over 10 years, we'd be pretty happy with that average return, right?
I certainly would. And, you know, that calls out a key call out here, is knowing that you need time, you need to invest, and we're not speculators. You're calling it out and recognizing you're going to go ups and downs. But if you have time to really invest, those will play out and play out well for you, as according to these data.
And that's a great transition to the next slide, Tom, because setting your sights on the long term is key. I mean, the 3 things to keep in mind are successful long-term investors. They stay the course. They rely on time in the market over timing. You can see that with those 10-year averages that we just talked about. And investment success, luckily, has depended more on the strength and resilience of the American economy. Which candidate or party holds office has had little impact as long as people are patient and stay invested. Number
Mm-hmm.
three involves folks like myself, the experience and time-tested process of a financial planner. Us at the OneAZ Wealth Management team, we're here to be an important contributor and help you stay patient. It's one of my favorite Warren Buffett quotes is the stock market is where patient people go to take money from the impatient. And that is the job of your financial advisor, is to help you weather the noise of what the news tells us and throws at us every day, really.
Oh, it sure does, because we can get so spun up on the media hype of issues and problems of the world, but we know what can chug along is our economy and the underlying needs of just basic fundamentals. If they're sound and they're solid, we'll all do well, but we need that time in the market for sure.
And investing during the election year is tough. We're all rooting for a candidate or rooting for no candidate, depending on where you stand. And it affects the nerves, the
Mhm.
noise of the morning show that you watch, the news show that you listen to on the way home. All
Mm.
those things spark emotional decisions. But if you looked at that first chart, if you look at this chart here, which political party has been better for investors? This once again goes back to 1933 in this case. It's $1,000 investment into the S&P 500. And for those that aren't aware, the S&P 500 is 500 of the largest U.S. companies. It's one of the major indices that tracks the stock market in the U.S. and what they call a broad-based indices. So it actually gives you a good idea of what is
Mhm.
happening in the U.S. stock market. And $1,000 would have turned into $19 million. And yes,
Wow.
this is a long time, 100 years. But even at any point, $1,000 turning any one of those numbers would be a great return.
Yeah.
And you can see the red and blue.
Mhm.
And you see the ups and downs. However, the general trend is things go up over time, and as long as you have quality investments and patience, you're going to get what you're looking for, the investment returns that you need to be able to accomplish your financial goals.
Yeah, that is so true. I think too many people want to get into the markets and just want to speculate, and they roll the dice and they think it's kind of like Vegas, that they're going to they double their money quickly. Well, good investing is not speculation. It's time in the market and time testing the process. And as you can see, all these trend lines are going in the right direction, but you need the time, because if you do too short a period, yes, you could experience a loss. But again, longer term usually will pay all out to be a win for everyone.
And these slides here, the previous ones have talked about, the longer term investing and how it deals with your
Hmm.
political party. I like
Hmm.
this slide here because it talks about what happens during the election years.
Oh, yeah.
You can see the shaded blue part where there is a lot of volatility in the primaries before we decide who is running against who, Democrat versus Republican. You can
Hmm.
see that there. Typically, it is a little muted return for the first couple of months. However, like Tom, like you mentioned before, we've had a great start. The S&P 500 is up 5.3% already this year. Typically, after we've decided who our two candidates are, next 12 months is fantastic with an average 11.3% return.
Wow. I mean, this is a real call out. It's these choppy times, right, Zach, that we just have to handhold people, but really it's ours also buying opportunities potentially. The most of,
Exactly. We were at
Mhm.
13 Republican candidates in the middle of last year. We're already down to two. We may be down to only one here relatively shortly. And if
Mhm.
that does happen, this will become in history the longest one versus one Republican versus Democrat race in U.S. history for the presidential race. So it
Wow.
should get interesting.
It sure will. That's a good call out.
And then I really like the next slide as well. It goes back to your point of too much money on the sidelines.
Mhm.
People are nervous about the markets. Every single candidate that you hear listen is really amplifying all of the country's problems. But when you talk to economists, you can see that the US economy is doing just fine. People are getting jobs, wage growth is going up. Yes, it's harder to buy a home at some point, but the rest of the economy and everything else is running relatively smoothly. And that's really why it shows here in this chart during a presidential election, why wait to see who gets elected before moving your money and doing what you should with it. It's important to have that plan, a long-term strategy in place, and not let who wins the White House dictate, because as these slides in history has shown, it doesn't matter that much as long as you have a long-term strategy in place.
Yep.
And then when we take a look at the next slide too, Tom, it dives into even more why you need to have a sound and strategize your investments before things happen, because we look at three different investors, pardon me. We did a hypothetical looking at them 4 years investing $10,000 a piece, and the person that's fully invested historically, percentage-wise, has a much better chance of having a return than the person that sits on the sidelines with their cash and waits for the market to be good. We hear that a lot. I'm waiting for the market to be good to invest my money. And that is one thing that cannot be answered or predicted. And you can see consistent contributions helps just as well. It's the beauty of our 401ks or IRAs. When you're putting in monthly amounts automatically, you can see you don't trail very far behind the fully invested person.
Oh yeah, it's almost virtually the same, really. And it's the key is making the commitment, because those that are sitting on the sidelines, they're the ones that are on the short side.
And I like this chart too, because it proves that we're not all just going to have $10,000 to invest. But if you are consistent with $1,000 investment, that's much easier to wrap your head around. You can still accomplish your goals with these investments as long as you are consistent with those contributions.
And that's another interesting thing. If you look at these numbers, here in the best case scenarios, 14 out of 22 different cycles, they'll be positive, they win. And here on the downside, 16 out of 22 times, it's the worst case scenario to be sitting on the sidelines.
And I'm a baseball fan, Tom, so batting average is what it's all about. That fully invested person would bat 636. It's a Hall of Famer.
There you go.
I would choose that if I had to send somebody up to the plate for me.
All right. Okay, let's look at this last slide. This is the summary slide for you, isn't it?
It is, Tom. This will help me wrap up, give you 4 key takeaways, and I appreciate the opportunity to speak here. And really what I've hoped we've taken away from this presentation is, one, U.S. stocks have trended up regardless of whether Republican or Democrat won the White House. Number 2, primary season tends to be volatile. This year we've seen it, although we're positive, it has been a volatile positive market so far. But after the primaries are done, markets have historically bounced back strongly. Number 3, investors often get nervous. They move into cash during election years, when we can see that's not always the right course, and a reason to speak with your financial advisor and to have a plan. Number 4, staying on the sidelines, very similar to the last point, is rarely paid off. It's about time in the market, not timing. So sit with your advisor, discuss your investment strategies, and discuss your timeline and your risk tolerance. It's things like that should dictate how you're invested versus really whatever political party gets elected.
Yep, absolutely. Well, thank you so much, Zach. As we get ready here for some of the Q&A, let me just kind of glance or thumb through some of these disclosure slides. Now, trust me, these slides are available and you'll be able to look at them and review them. You can print them off of our website and be able to have all of the information. And even our speaking notes are going to be on these slides for you as well. All right, let's get started with some Q&A. We still have about 10 minutes to go. So the first question, Zach, is what is the outlook for the housing and interest rates? Well, I guess I'll take a stab at it. I mentioned earlier that we here in Arizona kind of live somewhat isolated and insulated when it comes to some of the things that are occurring in certain pockets around the country. But housing and interest rates, we think they're going to come down maybe 2 cuts. Some forecasters are forecasting 3, 4, 5. But I think 1 to 2 cuts is very reasonable. Let's hope we get that. We don't want to go down and cut too fast and get things flurried up too much. Housing will definitely rebound when interest rates start to come down. The affordability of homes will come into play by mortgages being a little lower so people can buy. But Zach, the area when it comes to this that concerns me about interest rates is something that you're hearing more about now, and I've been worried about it and talking about it for the last 3 years, and that's commercial lending, really this commercial real estate.
Yeah.
What do I mean by commercial real estate? Right? What has happened since COVID? So many people are now working from home, and I'm not saying that's a bad thing. I'm just calling out a reality that many of our corporate buildings are sitting half empty or with lots of empty space because workers are working from home now. Technology advancements and flexibilities have allowed this to happen. So there are companies that are renting space where they don't need it.
Yeah.
So there's going to be a time come when these leases come up. There's going to be 2 things. The tenants are not going to want as much space, right? And then they're going to ask for reductions in their lease because they don't need as much space. And then on the other hand, when the leases or when the loans on these commercial buildings are coming up for renewal, they're readjusting at some higher rates. They're not at the low rates anymore. They're getting readjusted to high rates, causing higher payments that the landlords or the owners of these businesses and companies, the owners of the buildings rather, are going to have to pay. So you've got 2 things badly happening here. You got the tenants, the companies not needing the real estate, and then you have an increasing cost of owning the real estate.
That is a troubling headwind, Tom. That definitely could affect market returns. There are companies that won't make it out of this, companies that specialize in commercial lending. We can see one New York Community Bank Corp has been making the news quite a bit lately and making the news for not quite the right reasons.
Yep, absolutely. The next question, okay, is please address investment opportunities with medium risk other than annuities. Zach, do you want to handle that one?
Yeah, I do like the question, Tom. It definitely can be a tough question, and medium risk can mean a lot of different things to a lot of different people. It is why myself and advisors and OneAZ Wealth Management do take our members through a risk tolerance questionnaire to understand what medium risk means for them. There are other investment products that have medium risk, depending on what that means to you, and too many products to name over the phone here. It kind of depends on what you're looking for your money to do. So I would encourage you to email OneAZ Wealth at oneazcu.com. Be happy to have a follow-up phone call with you and discuss what medium risk means to you and give you a few options.
Sure. And along with that risk, right, is time horizons, because that you can't do one without the other. You need to know how much time somebody has to invest. So the critical component of every investment, it's an art form, really sitting down and designing a portfolio, or really finding the investment solutions that are going to fit each individual person's risk tolerance, but also time horizons. And that's one of the things the advisors do very well. So thank you for calling that out. Okay, here's another question, Zach. Maybe you want to handle this one. It says, at 53 years old, is it too late to benefit from investing?
Happy to answer it, Tom. And I like to change that to 53 years young.
Okay, all right.
Age is just a mindset here. And
Yep.
Absolutely, no, not too late to start investing. Are you late to the game? Yes. Are you probably going to be able to retire and do exactly what you want to do, the retirement of your dreams? Maybe not. However, at 53, if you haven't started, the time to start is now. There's no more time for procrastination. Call myself, one of the advisors, tomorrow morning, and we'd be happy to discuss a plan for you, because starting now would still give you the opportunity to have 30, 40, 50,000, depending on how much gumption you have to put towards this. still going to have the ability to have that nest egg. And we've dealt with both sides of it, Tom, where someone is just retiring on Social Security alone versus the person that's retiring on Social Security plus having 50 to 100,000 as a nest egg. And it's obvious that the person that has an emergency fund that can travel to see family members every once in a while, that can take care of their needs, is just better off. So absolutely not too late, but it's time to get going. That's for sure.
Sure, sure. As they say, it's never too early or never too late. And I think more importantly, though, it's a call out. As we see people so often that are in their 50s, right around that 50, when you turn 50, there's this wake up call that you have fewer tomorrows and I mean, fewer tomorrows than you do yesterdays, as they say, right? And it's so important to say, oh, wait a minute, where am I? And can I have a successful retirement? And that's what good planning does. And I urge you, all of you that are on this call, if you haven't sat down with a good advisor, to sit down and just do a thumbnail sketch, a numbers, do some analysis, quick, easy. And being part of OneAZ, our advisors are here for you, complimentary. They will sit with you and do some calculations with you to do some numbers to say, hey, you're on track, or no, you're not. Here's what you can do. Here's how you can change, what you need to do to make sure you can retire at the level that you like. So it's so important. The sooner the better, though. Sooner the better. Okay, last question, Zach, is about elections. It says here, elections will affect the stock market, and who will be getting in? Well, it says here, will our stock market plunge, and what will it do to our economy? So I guess they're just very concerned about the elections, right?
And concerns are understandable with everything we see on the news each day, the couple wars going on, the border to the south. Seems like every day there's something new. It's understandable. However, historically, it's shown that it really doesn't matter which political party gets nominated and gets elected. As long as you are fully invested and you stay patient, don't let emotions dictate your investment moves. Things have worked out pretty well. You know, these are all averages, but that is why we speak to you about your specific time frame. You mentioned time frame before, Tom, and I think time frame is even more important than the risk tolerance, because time frame dictates the type of investments we can use and lets us help understand what sort of risk you should be taking at this point in your life. So yes, it may be volatile. We've had a few elections that have had dips right after the election because a different candidate was elected, but the market's always bounce back very strongly. So it shows by the numbers that it's not a time to stay on the sideline. It's a time to be diversified and have a strategy that works with what you're trying to accomplish financially.
Yeah, so true. You know, we let emotions take control of some sound decision making we need to be making.
We all
So
do in every aspect of life.
Yes, we do. Yes, we do. And that's what good advisors will help you with, is help separate that and really help you make better decisions with good information. So as a wrap up, I want to say thanks, Zach, for this presentation and sharing tonight with me. And I want to thank all those online and watching. Thank you for watching and listening. Thank you for joining. And I hope this discussion today has been helpful and provided you some ideas to think about when it comes to the 24 outlook, but also investing in an election year. We all here at the OneAZ Wealth Management team, you know, we welcome your feedback and comments. So please, I say, please email us any suggestions you have for future webinar topics. As always, our OneAZ Wealth team of advisors stand ready, willing to assist you in reviewing your current plan or just creating a brand new one. So don't feel that you have to have wealth to come see us. I love starting fresh. I met with somebody just earlier today, who was 22 years old, very excited, wanting to get started. So we got him started on a new track. You know, there is no better time than the present also for a second opinion. So if you have a plan, then get it reviewed. It's always critically important to make sure you are on the right track. You might learn a few new ideas, discover some new concepts, some strategies that might better suit your needs. And we welcome your call and we can help you. Again, we're complimentary to all those that are OneAZ members. So we want to call us at the 877-566-0517. You can call us. You can visit our website, oneazwealth.com. And on that website, you can see our advisors and actually click and schedule an appointment or even a phone call with them. It can be a brief call if you'd like, just to schedule it, get it going. And remember, procrastination is the killer. So don't wait. Again, I want to thank you all for joining us. From all of us here at the OneAZ Wealth, I want to wish you the greatest of 2024 ahead. And we want to wish you lots of greatness for your safety, your health, and your wealth. Take care. Bye-bye.